Hello guys, thank you very much for joining in. We're going to be starting out of the second part of this chapter. A very small portion is left. We're going to be continuing with that. So the learning objective that we are trying to understand is basically we are entering into the space which is called as the alternative investment. What are the unique feature or characteristics that you see when you look at alternative investment? We have already covered a big chunk of this chapter which talks about the basics of alternative investment. How do you look at various factors of risk and return? Basic understanding has been already covered. Okay. Let us start with the first part over here. What is so unique about alternative investment and how it is so different from a traditional way of looking at an asset or traditional asset? Okay, the first is structuring, the way it is created. Okay, if you look at say a normal product like say a stock or a bond or even a futures contract on a bond, okay, it is not having that much level of complexity. For example, if there is a stock, for example Apple, and there is a futures contract on that Apple, this is still an example of a simple structure. But when you look at complex, when they are explicitly mentioning complex, one very good example of this would be securitization. What is that? So for example, okay, there is say Citibank, they have a pool of home loans. Okay, let us assume there are 10,000 home loans. Okay, this pool has been transferred to a special purpose vehicle which has been only created to sell a new instrument. Okay, what the special purpose vehicle will do? Special purpose vehicle will pay the dollar amount to the main entity, Citi. Now who is the owner of this pool? It's basically special purpose vehicle, and on this pool they are going to issue, okay, a structured product. Okay, it could be like CMO, which is collateralized mortgage obligation. Over here I can create variety of tranches. Okay, tranche 1, tranche 2, tranche 3, tranche 4. So there are different investors in the market. So some investor might prefer the first tranche, some investor might prefer a different tranche, because each tranche has a different cash flow, different risk and return perspective. So what I'm trying to highlight is this is an example of a complicated product. Okay, securitization is going to come more in detail in the later part of the curriculum. Okay, so they've given you the reference that what exactly is securitization. You have a pool, okay, and you're basically selling it in terms of different instruments. What is that instrument? We talked about, if you remember in the previous section also, the senior tranche, mezzanine tranche, equity tranche. Basically what I'm doing, I have a pool of 10,000 home loans. I have created different instrument on that pool and I'm selling it to the investors. Okay, so look at this example. A home loan can be converted into a mortgage-backed security. Same logic. Okay, you have a special purpose vehicle. Okay, there's a pool of home loans. On this home loan, you are basically selling a MBS, mortgage-backed security, to whom? To the investor. So investor is buying this MBS, which indirectly controls this pool and indirectly gets the repayment of the EMIs. Who creates the special purpose vehicle? So generally it's the parent company. In our example, it was Citibank, which is creating a special purpose vehicle. Okay, this special purpose vehicle is nothing but a sister concern company. So for example, if it is Citibank India Limited XYZ, that is nothing but an SPV. We have created this entity only to sell this structured product in the market. Okay, each product, okay, has a different type of risk and return. Okay, so for example, the way I create MBS is going to be different than the way I create CMO, collateralized mortgage obligation. Okay, in CMO you had tranches. In MBS there is no tranche, there is only one instrument. So different types of financial engineering can be done and different types of instrument can be created depending upon what is the risk return requirement of the market or the investors. Okay, so the first point, that the way an alternative investment is structured is very different. That has been covered here. Understanding the unique characteristics of alternative investment, in that you will be looking at second part, the regulatory factor. Okay, now the way a regulator in India or globally looks at traditional products like stocks and bond, okay, is very different, because in stock, when it is listed on an exchange, okay, the government or the regulator is more focused on protecting the average investor who is investing into that product, the traditional investment products, right? So when you go and invest into a stock product or a stock, okay, it is regulated heavily. Okay, there is a lot of disclosure that happens at the exchange level. There is a lot of disclosure happens at the company level. Why? Because they want to protect the retail investors who are participating into these traditional products. So it is heavily regulated. But when you look at alternative investment, the regulation is lesser. Why? Because generally the people who are investing into these kind of products are people with high net worth, who are generally financially sound. They understand what is the implication of these investments. So the government expects that if you're investing into these alternative investment, you have the understanding about the risk. Okay, so there is very few regulation, and because there is very few regulation, the alternative investment space can take extreme risk. For example, hedge funds, they take extreme leverage to generate returns. So they are not using their own money, they are using somebody else's money to generate high amount of return. That is only possible because there is no government regulation. If you look at mutual funds in India, it is highly regulated. So over there, you have to give details every month. There is a fact sheet that you have to come out with for your fund. Next, you cannot do short selling. You cannot take leverage. So there is so much restriction in your activity. In hedge funds, in alternative investment, you get more flexibility, which helps you to increase the returns. Okay. So over here, I've given you the example of mutual fund and hedge fund. Okay. The basic logic is that the regulators realize that if you're investing into alternative investment, you understand the risk and hence it is less regulated. This was the second factor that we have talked about. Okay. Third factor, institutional factor. That means who is my customer? Okay. Majority of the investors you will find in the traditional aspect, they are retail investors like you and me, who have got some bonus, who has got some income, and they're investing. But when you enter into the alternative investment space, most of the time you'll find the client is a big investor or an institutional investor. That means an LIC, for example, in India. Okay, they have huge cash available and they want to invest into these alternative assets. Some insurance company, for example, some pension fund company. Okay, so they want to invest into the market. So most of the time the client size is very big. Okay, and they are not much worried about the risk and return as such, in the sense they have a team which analyzes the liquidity, they have the team which analyzes the risk. Okay, in certain companies, okay, they might be restricted with their internal policies that okay, I will only buy real estate which is listed on an exchange, that is REITs, real estate investment trust. I will not directly buy a physical real estate asset. That could be a restriction. So then they might get impacted. Okay, because then they are only investing into liquid securities. They are not investing into illiquid. That could be possibility. Okay, a hotel owned by a publicly traded company. See this, hotel owned by publicly traded company is considered as traditional. Why? Because you're buying a stock of ITC. ITC is into tobacco, into hotels also. So when you're buying a stock of ITC, you're indirectly getting an exposure into their hotel business. But that is a traditional investment. But if suppose you yourself buy a hotel or you invest into a private equity fund and that is buying an hotel, then that is an alternative investment as a difference. Okay, so you can understand who is the clientele. Okay, who is the clientele, basis that also you can bifurcate whether the asset is an alternative investment or it's a traditional investment. Okay, the ownership and trading method can easily impact an investment that we are talking about. I'm going to take a quick pause. Any query, any confusion till this point? All good. So 3 factors is what we have covered till now. Okay, let us go to the next, compensation. Now the compensation over here is of the fund manager that we are trying to focus on. Now, when you compare a fund manager who is sitting in hedge fund or a fund manager sitting in mutual fund, okay, mutual fund, they have to perform, okay, they have to give returns, but they have to do it under the regulation. But hedge funds can take huge risk, can generate returns. They can take extremely different type of strategies and take position. So their compensation structure is generally higher. So they have the 2 plus 20%. Okay, 2% is the main the management fee. So if I'm managing 100 crores, every year 2% of whatever asset I'm managing is given to me, which is including my salaries and general bonuses and all of the staff. Okay, the rent, selling expense, all of these will be included. But if I'm able to generate good amount of profit, I'll end up making 20% of the profit. Now, obviously, it depends how we can structure it. But what I'm trying to highlight is over here, the compensation structure for a fund manager who's sitting in an alternative investment space is going to be with higher fees, and also the incentive, which is based on the performance, is also going to be higher. But when you become a fund manager of a mutual fund, okay, the management fee is also going to be lower and the incentive is also going to be lower, because you're not actually taking a very high amount of risk, and your investment strategy might not need that much amount of detailed understanding or niche understanding, which is required in the alternative investment space. Okay, so over here 2 plus 20% is what I talked about. In the mutual fund industry, it is generally 1 to 2% or lower also, depending upon what strategy I'm entering into. Okay, so the way they structure the compensation, because it's a high risk game, there could be a chance that the fund manager could take extremely high risk and the investors could lose money. So they have to create the structure in such a way that it does not create a conflict of interest, because the fund manager might put entire money at risk with the hope that he'll be getting a good bonus if the investment works out. So that they want to avoid. They want to take risk, but it should be calculated risk. It should not be extremely high risk. That is what the conflict of interest which you have to manage when you're structuring a compensation part. I'm taking a pause, read this point. Answering to your query, Rohit, if you invest in a hotel chain owned by a public entity, but in a private way via SPV, see, if you're still, will it still be an alternative? You have to think it like this. If I am a shareholder, that means I have purchased a share of a company or any structure, and that is investing, then it is mostly traditional. Okay, if I'm investing into a hedge fund, private equity fund, then it becomes an alternative space. Okay, Rohit, I have answered your query. We have completed the fourth point, trading strategy. Very interesting, because when we do the hedge fund section, they are going to be talking about variety of trading strategies which ideally hedge funds use to generate return. Okay, now there is a basic difference which is covered in the curriculum also, which is what is active investing and what is passive investing. Now think of it like this. Okay, when you're doing a passive investing, okay, I have my portfolio P. Okay, I will try to find a benchmark. Okay, benchmark generally is the index. Let us assume that index is S&P 500. I will create my portfolio which will exactly match the benchmark. So if my benchmark goes up, my portfolio also goes up. If my benchmark goes down, my portfolio also goes down. Okay, that is nothing but passive investing, where once you have created the portfolio, you might have to change it very less. If there is a change in the index, then you have to change. Okay, so passive investing is basically invest and forget. But when you look at active investing, you have to think it like this. Okay, active investing, suppose this is my benchmark. In my benchmark, there are 3 assets which are invested. Okay, so let us assume over here you have invested 20%, over here you have invested say 30%, and over here you have invested 50%. Now this is the benchmark, but I, being a fund manager, okay, I'm just showing you one scenario. Okay, I am thinking that this asset A is actually going to grow up. Okay, so let me put more weightage into asset A. So I'm changing the weightage because I want to beat the benchmark. I just do not want to follow the benchmark. I want to generate a better return than benchmark. Okay, so suppose I might be investing 30% over here, 40% over here, and 30% over here. This is one example of actively managing portfolio. So you have to continuously track the portfolio to see how the portfolio is performing as compared to the benchmark, and then you have to take the either increase or decrease your strategy. That is a very good example of an active investing. Okay, you buy and sell frequently, you change your positions in the portfolio frequently, okay, so that you can manage that return. But when you're buying and selling frequently, you might face an extra cost. Okay, in comparison to that, passive investing, basically you hold for a longer period of time. Like I said, invest and forget. Okay, so an example of passive investing is index fund. Index fund is nothing but you have invested a money into a fund. Okay, that fund is also listed and it tracks an index. It is almost a mimicking index. Okay, active strategy, hedge fund is a very good example of an active fund, active strategy, where what they do is you have given your money to a fund manager. Now he is going to take positions in the market, will give you a return. He want to beat the benchmark because he want to show you a comparative performance. Now over here, the basic difference is how do you want to generate profit. If you want to generate extraordinary profit, obviously extraordinary profit will come at extraordinary risk. That is basically your active trading or active investing. That is a fifth point that we have talked about. Okay, information asymmetry. Okay, now information asymmetry means if I am going to enter into a transaction, whether buyer and seller, both of them have similar kind of information or not. Okay, if there is information asymmetry, one party might make more profit. Now think about this. You go and buy a real estate flat or a bungalow. Okay, and you're new to that location. You don't know what is it. But somebody who is selling it, he knows everything about that location. He's been staying into that location. So he has more information as compared to you. So there is an information asymmetry. So whenever you enter into niche products, alternative investment products, okay, there is always a risk that there is going to be some party which is going to have more information than you. Okay, some investors have more knowledge than others, so they would try to benefit from it. Why is this happening? Because the market is not structured, it is not transparent. The way you see a price of a stock on an exchange listed, right? You see the price on a date when it is trading on a day-to-day basis, but you cannot see the price of an alternative investment strategy like real estate. It is not listed. So because there is no transparency, there is less information coming into the public domain, and because of which you are not able to understand the information part. Okay, information part. Very simple example of this would be if you are a company insider, if you're already working for a company's senior management, you know indirectly what are the new projects that are going to come. You have more information as compared to the general public, right? What is venture capitalist? Venture capitalist basically invest into a startup. When you are already invested into a startup, you know how the startup is performing, which new patent they are going to file, right? What new product they are going to come out with, right? Investors who lack information, okay, they might end up paying more, and they might also end up taking more risk, because it's like this: you have invested into a property, which into an area which you're not aware about. Okay, there can be legal risk, there can be actual property related damage risk. Okay, so many risks that will come. So before you invest into any alternative investment, you need more research as compared to a traditional investment approach. Okay, sixth point we have covered. Seventh, innovation. Now, if you look at the traditional market, like investing into a stock or bond, for the last 50-60 years, it has almost been same. But when you look at alternative investment, new products are coming in. For example, real estate investment trust, which was not there previously. If you want to have an exposure, if you want to get an exposure to real estate, ideally previously you were supposed to only buy a property or purchase that asset. But now you have mechanisms through which you can directly buy without taking that much amount of risk. So there is good amount of financial innovation that is happening into the alternative investment space, which means there are new strategies, new product coming in, so new action happening. And for you, it is now becoming easy to analyze the risk, okay, because as the fintech and all of these companies are growing into this space, it is easy for you to access the data. And when the data is there, it is easy for you to look at the return, look at the risk properly. Okay, few examples. Okay, cryptocurrencies and blockchains are coming heavily into the market. Okay, hedge funds are also coming out with new strategy matching to the new trend in the market. So as a fund manager, if I'm going to invest my money and give it to a fund manager, I know that this fund manager is going to be actively looking at the market and he will adapt to the market to generate good returns for me, right? So as an investor, as a fund manager, you have to be updated with the alternative investment section so that you don't miss the trend, you don't miss the benefit portion. So seventh point is innovation. I'm going to take a quick pause. Any query, any confusion? All good? What is a benchmark? Benchmark is nothing but I want to compare it with something. So generally it's an index. So in India you have Nifty, Sensex. These are indexes which are available for everybody. You can also create an index. It is nothing but you're comparing it to a portfolio, because Sensex is also a portfolio of 30 stocks, right? You have S&P 500 which has 500 stocks. So it's a portfolio. So you're comparing it to a portfolio. It can be a well-known name like a S&P 500, Nifty, or Sensex, or a bank Nifty. Okay, but you can also create a similar portfolio to compare. Okay, Prachi, I've answered your query. What do you mean by hedge funds creating new strategy? So there are so many strategies, like for example, long short equity. In the previous chapter, previous session, we talked about the example of merger arbitrage strategy. So there are a variety of strategies, new strategies they are coming up with, depending upon what kind of models they're using. Okay, the examples of strategy will be available in the further chapters as we cover hedge fund. Okay, look at the next part, incomplete market. Now see, the concept of incomplete is connected to the transparency point. Okay, because the information is not easily available. Okay, regulatory restrictions are not that, because if the regulatory restrictions will be there, they will ask for more information to come out. Because there is less regulatory intervention, okay, and the information is not available, okay, you will end up finding that the market is inefficient. That means the investor who has specific knowledge will be able to make money. Investor who has certain amount of money, he will be only able to make money. How come? Because if suppose I want to buy a huge building, okay, or a tower, and I have realized that this asset is available at a low cost, but I cannot enter because I do not have the money. Or else there could be entry level restriction. For example, if you want to enter into an hedge fund, the minimum ticket size is 10 crore rupees, say for example, then you cannot enter. Okay, so likewise, the market is inefficient, okay, because the information is not available. There are barriers in certain ways, okay, and only certain people who are allowed to enter. And people who are entering also, they are taking more risk because they want to generate more returns. Because ideally, if I am an ultra high net worth individual, I can invest into stock and I can still generate 12%. I can invest into mutual fund, I can generate 11, 12, 13%. If I'm entering into an hedge fund, I want 20, 25% return. Correct? Now over here, there is good amount of moral hazard. That means moral hazard is a very simple concept which connects to this. I'll give you an example. Suppose I have hired a plumber to do a work at my house. He's charging me on the basis of per hour. How many hours he's going to put in, he's going to charge me. Correct? Now your interest is to make sure that the work gets completed in lower time, because then you're going to pay lower, but his interest is exactly opposite, right? So there is a conflict, and this creates moral hazard, okay, where certain people might behave very differently. So in your example, in this hedge fund example, there are fund managers, they might end up taking excessive risk, okay, which can create a problem for you as an investor. Okay, look at this. Insurance market do not always offer policies for unusual risk. They generally provide policies for specific risk, like for example, life, health. Okay, if you want to take unusual risk, like you want to cover ICC World Cup, then your premium is going to be extraordinarily big. If you want to cover Olympics, insurance cover, the premium is going to be very high, right? Banks selling loans to other investor may not carry about the loan quality. This is moral hazard. I have initially given a loan. Now I have a portfolio of 10,000 loans and I'm selling it to somebody. So I'm not very much concerned what is happening in that 10,000 loans, because it is not going to stay on my book. This will create moral hazard, and this is one of the biggest problem in the structured market product. Okay, incomplete markets create opportunity for investors. People who are at the right time, who understand the market, who has the information, they will be able to make more profit. Okay, and by default, alternative investment space is more riskier as compared to traditional. So because there is high profit, there's going to be slight higher amount of risk also. So this is where we complete the 8 points, okay, the 8 sections. Now all of this is kind of summarized over here. So when you're reading the presentation also, you can walk through this point and just have a quick summary till this point. Okay, before we go to the next point, next section, any query, any confusion till this point, guys? All good? All good? Okay. The next section, alternative investment goals. Okay. Now, basically, they're trying to highlight that if I'm an investor, I have some portion invested into a traditional structure. Why am I putting other portion, say 20-30%, into an alternative asset, which is slightly risky? Okay. So, what is the goal? So, one of the basic reason could be I want to generate high return and I have the appetite to take risk. Okay. So, over here, we are talking about those kind of goals. Okay, whenever you are investing into alternative investment asset, okay, the few main reasons that people want to enter is, one of them is actively managed. That means they want to manage, they want their portfolio to be managed actively. They want some fund manager who's only going to look at their portfolio and take decisions. They don't want to invest in a passive manner. That means I'm going to track an index. Okay, so that could be one reason. Second, I want to not only just generate return on an absolute basis, I want it in a comparative basis. So when I'm doing active investing, I talked about this. I'm going to compare myself with some benchmark. Why? Because I might have generated 10% return, but it is not good when I'm comparing it with somebody else. So entire market of your hedge fund, private equity fund focuses on what is the return that you've generated as compared to a benchmark. Generally, it's an index, but you can also create your own benchmark. Okay, all of these pointers are going to come in detail. Huh? So we talked about active management, we talked about this, arbitrage and return enhancement. Now arbitrage, I'll give you an example which I'll be covering as we move ahead also. So think of this. There is an asset A, okay, which is available in two markets. Okay, market 1 and market 2. Okay, ideally the price of the asset should be same, but suppose in market 1 it is 100 and market 2 it is 102. So there is an arbitrage opportunity because ideally the price should be same. Okay, but over here what arbitrages do to profit from this, whenever the price is higher they are going to sell, whenever the price is lower they are going to buy. So when they start buying, over here the price goes up, when they start selling the price goes down, and the difference will be mitigated. That's a theoretical concept. Now in reality, okay, it will not exactly be same because there is a transaction cost also. So there might be some gap between the two prices, some paisa gap or some cent gap. Okay, because if I buy and sell, there is a transaction cost which is going to hit me. That gap is lesser than the transaction cost, so I will not enter, because if I enter I'll face a more cost. So I'll leave that. So over here what is happening, an arbitrager is going to make money because the asset is priced differently into two different market and I want to make profit from there. Okay, that is an arbitrage. And we try all of these strategies. Why? Because we want to generate excessive return. So when we using the word return enhancement, it is nothing but the investors are focusing on increasing their chances of making return. Okay, and also the number of return. Okay, because they want to take high risk. Diversification. Now this concept will come again and again. What is diversification? I am an investor. Okay, I have put 10% of my money into direct stocks. I put 15% into mutual fund. Then I put some money into bond. I put some percentage of money into real estate asset. I have also purchased some commodity, some IP, like that. So I bifurcated because I want to reduce the overall risk. So diversification is used by investors to reduce the overall risk of the portfolio. Okay, avoiding missed opportunity. Now what is this missed opportunity? It is like this. I am a retail investor. I have invested entirely into stocks and bonds and all. I have kept certain money in cash, okay, which I can invest whenever I see, suppose a real estate property value is going down, I will go and buy. Okay, or I will invest when the cryptocurrency goes down. This is nothing but I want to make money, okay, to avoid, I have kept some cash available to invest immediately to avoid that missed opportunity. Okay. Ronak, answering to your query, does active management means churning often? Yes. When you're using the word churning often, it basically means I'm buying and selling often. Okay. Now this concept I've already talked. What is passive investing? Buy and hold. Like I said, invest and forget. And you always try to compare yourself with the benchmark. What is an example of a benchmark? Nifty 50. Okay, there are many benchmarks, many indexes available in the market. What is active investing? Okay, you buy and sell frequently. Why? Because you want to beat the market. You want to generate a better return than the index. Okay, and that's why active management is also called as active risk taking. Okay, why? Because I want to generate higher return, which is nothing but alpha. Alpha. Okay, so how do we do it? Like I gave you an example, if the benchmark is having first asset A 10%, I might either increase or decrease depending upon what is my view. So I'll manually adjust my portfolio so that I can generate good amount of return. Okay, most alternative investment use active management. Okay, I'm going to take a quick pause, read till this point, and I'll just be back. I hope everybody has been able to read till this point, difference between the passive investing and active investing. Okay, look at this example of arbitrage. What does the arbitrager generally do? He will try to find the difference between the price of an asset in two different market. Okay, at one he's going to buy. Okay, at one such location he's going to buy, at one location he's going to sell, and he wants to make profit from that. For example, if the price in India is 50,000 for 10 gram gold and somewhere else is 49,500, theoretically what you can do is you can sell wherever the price is higher and you can buy wherever the price is lower. Okay, obviously this example is slightly different because you will have to pay the cost of travel and all. I'm not considering that, but theoretically you can make profit. Okay, that is nothing but your arbitrage. I'm going to take a pause and answer the query. Example of passive investing, Vibha, we already talked about this, na? Passive. See this, passive investing. I have a portfolio P. Okay, I'm mapping it to a benchmark. Suppose the benchmark is S&P 500. So whatever assets it has there in the benchmark, suppose asset A is 10%, asset B is 20%. So I'll create almost same in my portfolio. Basically, I will try to mimic the benchmark so that I can generate a similar return then as compared to the benchmark. Okay, Tejas, answering to your query, would hedge fund long-term investment strategy be considered as passive as well? No, it is an alternate or active strategy. Generally, it is an active strategy. Okay, Vibha, answering to your query, but this is a traditional investment, yes, because you are investing into an index fund. Index funds are listed on an exchange. You put money into that index fund is going to track the index. Okay, for alternative, passive investing could be like buying a property and forgetting about it. It is like that. That is an example of an alternative, Vibha. Okay, what is return enhancement? I am trying to increase the average profit that I am going to earn from a project or a asset. Okay, now when you want to increase the return, okay, either you will have to change the structure of the asset or else you have to increase the investment. Okay, now These investment may have a higher risk, but with higher potential return. Okay, simply if I'm going to buy, okay, a high risky asset like a penthouse, okay, or an entire floor on a mall, the risk is very high, but I'm having control of many what do you say, many properties. So I will be able to sell it at a very high price, or might be able to sell it to one person at a very high price. So over here, what they are trying to highlight is the return enhancement concept comes from the logic that because you are investing into an alternative investment space, the risk is slightly higher, and overall your portfolio's return can be enhanced. So you have to think it like this. Okay, suppose you have a portfolio. Okay, in that portfolio you have A, B, C and D. Okay, this is a traditional investment. This is a traditional investment. When you are entering into traditional investment, the risk is lower, right? So whatever return that you are looking at is also low. But what you're doing is, in your portfolio, you're also adding these two assets, which are alternative investment assets. And these assets will have a higher return. Why? Because the risk is also high. Now think about this, that when I'm looking at my overall portfolio, I have added this C and D into my portfolio. Why? Because I want to enhance the return of the portfolio. Obviously the risk will go up, but I want to enhance the return of the portfolio. That is the logic. Okay, I hope everybody is good. So if I'm a venture capitalist, I would invest into certain startups, okay, which are high risky, but I know that in my overall portfolio, only one or two businesses like this are very high risky. And if they end up doing very good, I might end up making huge profit. That is a concept. Okay. Return enhancement. I hope I'm going to take a pause. Any queries till this point? Any queries, guys? All good? What is return diversification? Okay, so I am investing into multiple assets. I'm not investing into only one asset, right? So if I'm creating a portfolio, some portions are invested into traditional, some portion is invested into alternative. Within traditional also, I'm not investing into only one type of stock or one type of bond. I'm buying multiple types of stocks, multiple types of bonds. Okay, so why am I doing it? Because I want to reduce the overall risk of the portfolio. That is nothing but diversification. Now risk is connected to correlation. Now you have to think it like this. If I have a portfolio and all the assets in the portfolio are highly correlated, that means everybody is going to behave similarly. So if one asset goes up, everybody will go up. If one asset goes down, everybody will go down. So that is risky for me. So I have to make sure that in my portfolio, there are a variety of assets who are having low correlation or negative correlation. Then what will happen? If one asset goes down, the other asset is very least impacted. Okay, so that is how fund managers actually manage their risk. They do risk diversification, right? So I'm investing into gold also, I'm investing into stock market also. Generally what happens is stock market goes up, the gold price generally remains stable or go down. But when the stock market is going down, investors will go and buy the gold. So gold returns will be higher. So overall my portfolio will be able to generate good returns. Okay. Alternative investment helps increase profit. Why? Like I said, it is helping you to enhance your return. Okay. And because it is different asset which behaves differently than your traditional, it also helps you to do some level of return risk diversification, which means you will be able to make sure that the risk is at a particular level in your portfolio. Okay, that is the overall concept. Absolute return versus relative return. Okay, now over here, absolute return is nothing but, you have to think it like this. In the exam, okay, I want to get 70% mark. Okay, so I want, like in your investing, I want to generate positive return. That is a strategy. Okay, even if the market is going up, even if the market is going down, I want to generate positive return. Okay, so very good example of this would be a market neutral hedge fund strategy. This is an example of a hedge fund strategy. Okay, so I want to be neutral to market. That means even if the market goes up and down, I'll be able to generate X amount of return. Okay, now how do we do this? We have created a portfolio in such a way that I've purchased certain asset and I've sold certain asset. okay, so that the overall market movement is not impacting me that much. That is nothing but market neutral hedge fund. You can also create a factor neutral strategy, which means I do not want to get impacted by oil price movement. So I will create a portfolio in such a way that even if the oil price goes up, oil price goes down, it is not going to impact my portfolio return. It will still generate me some amount of return. Okay, so absolute return is nothing but I am comparing myself alone. I have generated 10% return. I have got 70% score. But the moment I move into relative, I am comparing to a benchmark, whether I have been able to beat the benchmark. Okay, so that is what is actually looked into the market. Okay, so it is compared to something. Now, those something can be an index which represents the market. For example, BSC ka Sensex. That Sensex represents what is happening in the market. Okay, similarly, you have Nifty. Similarly, you have S&P 500. Right? So you can compare yourself to an index to tell that whether I am actually performing good or not. Okay, look at the example. Long only equity fund. That means I am only going to buy. I am not going to sell. This will perform well when the market is doing good. Right? So when the market is doing good, you will be able to generate very good returns. You will beat the market. But when the market is going down, you might not be able to generate good returns because you cannot buy now. The market is falling. You have to wait. Okay. Many alternative investment use absolute return strategy. Okay, and most relevant is the relative strategy which is used in the market. Okay, I'm taking one small pause, asking you guys if there is any query. All good. Let us move forward. Diversification and risk reduction. Okay, what is diversification? You're spreading your investment into multiple strategy, and you want to make sure that whatever you're getting into the portfolio, all of them are either low or negatively correlated. There should be no very high positive correlation. Okay, correlation is generally captured between -1 and +1. If you have +1 correlation between two assets, then both of them are going to behave almost same. Okay, but what we try to do, we try to be on this side, either low correlation or negative correlation. How do we do that? So I have created my portfolio in which I've got stocks, I've got real estate, I've got commodity, I've got hedge fund, which brings in the concept of diversification. So I'm able to protect the value of the portfolio. Even if suppose stock market goes down, hedge fund, real estate, commodity will still keep the portfolio value at a particular level. That is diversification, which ultimately leads to reduction of the risk. Okay, now these are the same pointers in a summary format. Okay, so you can read it later on whenever you are preparing for the exam. Okay, pillars of alternative investment. This is the last part of the chapter. Okay, now over here, okay, they've given you a matrix at the end. Okay, now that matrix concept is very interesting. Okay, which is this, a 2x2 investment category matrix. Okay, and before that they've also talked about the two pillars of the entire management of alternative investment. So if I am a fund manager, what I should ideally look at? Okay, look at this section now. In the market, okay, there are new investment opportunities keep coming in. So you might find certain stock who's performing bad and you can buy it right now. During COVID, there were a lot of investment opportunities that were available, right? So as new investment opportunity emerge, there are traders, there are investors who will enter into the market. Now, if I'm a fund manager, I want to ask this question: should I invest now or should I wait? Okay, now everybody wants to enter early, okay, and become the first mover advantage. Like this, I could have purchased some stock of Google when it was at a very nascent stage. I could have purchased some stock of, say, for example, Flipkart. But everybody does not have that information. Everybody does not have that risk-taking ability, right? So as a fund manager, you are always tempted. Should I wait or see the market, or should I invest early and take the risk? Okay. So should I invest early or should I wait? Because if I'm going to wait, I might not be able to generate very high returns because the price will go up, right? So that could be a problem. Secondly, if suppose I'm going to enter into those assets which are new, okay, new assets, then I don't know what is the history. For example, blockchain or Bitcoin basically. 2010, nobody was aware about it, that how it is going to perform. So because it is a new asset, there's a lot of uncertainty. You do not have the historical data to track and compare, and hence it becomes problematic. So fund manager is always confused, or basically always into this dilemma. Should I invest early or should I wait? Now, how can you take better decision? Okay, look at empirical analysis. This means look at the past and see what has happened in the past. Now, this is not possible for new asset. Okay, this is one way to look at it, but we are making a very basic assumption that history will repeat. Okay, but what you can do second is that you can ask questions, logical question. Okay, suppose if in the history you have seen a particular asset going up, what was the reason that it went up? Is that reason valid today also, or it might come again in the future also? So use logical answer, okay, to logical questions to understand the jump in the price or the change in the price, and what is the market condition which was there in the past and what is the market condition now. So basically you analyze. Okay, that is what as a fund manager or as an investor you should do to better invest into these alternative investment space, because they're very different. Okay, what is empirical analysis? I've gone slightly into detail. Okay, so you take the historical data, say last 10 years data, 5 years data, you look at what is the return, risk, what is the trend. You do time series analysis, you can do regression, okay, all of different types of tools. You can look and see what has happened with the return, what has happened in the risk. Okay, so what is the average return, for example, for the last 10 years, average yearly return. But the question is the return going to follow in the future? Okay, so is my past going to replicate in the future? Can I expect something similar happening? So the question is this: if you're going to do empirical evidence, empirical analysis, okay, you're making a very basic assumption that the history is going to repeat. That is one problem with empirical analysis. Okay, this is one. Second, if I'm entering into new asset and there is no historical data, then what am I supposed to do? I cannot use empirical analysis, because empirical analysis is only about looking at the past, right? So for new assets, it is not possible, right? For example, for Bitcoin, okay, people who invested early, they took a huge amount of risk. Okay, but now there is huge amount of data available to look at the data and analyze and give an answer, right? So empirical analysis is useful, but you cannot simply rely on it. Okay, I'm going to take a pause. Let me know if there is any challenge. I hope everybody is good. Economic reasoning. Okay, what is the economic reasoning? You understand the logic, what has happened in the past. You look at the past data and you analyze the data. Okay, so if you in the past you have looked at some jumps going up and down. So what is the reason? Was there an announcement by the government? Was there an announcement by RBI? Okay, what has happened in the market? Any news that has come? Okay, so and then you ask whether this is relevant to today. And can you see a similar trend happening, continuing in the future? Now, historically, the Bitcoin prices are going up. Can you say that in the next 2 years also it will also go up? Because whether the trend will continue or not. Okay, so that is the logic that you have to check or ask the question. So if you see that the interest rate is rising, okay, and based on that you have thought that, okay, I'll sell bonds because the interest rate is going up. Okay, now this could be problematic, because suddenly, because of some rate cut, the interest rate might go down. Okay, real estate investment may struggle. Okay, because if the interest rate goes up, what happens? Your EMI cost will go up. So very less people will actually take loan. So real estate investment will reduce. Okay, so there is also connection with the economic indicators. Okay, even if real estate has a strong return in the past, it might not perform well. Why? Because now the interest rate has gone up. So even if you look at the historical data, it is performing very well, but now because of some external factor, the past is not repeating in the future. So you have to ask this question: why the history was doing good because the interest rates were very low at that point in time. Now it will not reflect because the interest rate is increasing. Okay, so basically asking a right question. Okay, so this economic reasoning is nothing but a reality check. Okay, whether the past trend will continue. Okay, that is basically been highlighted here. Okay, look at this part, past performance and future potential. What has been the past performance, what the history is talking about, and what is the future performance or future understanding. Now suppose in the past, because of some regulation, okay, the asset was not performing, but now the regulation has changed, and because of which you expect as an investor that the policies are favorable and the returns are going to be very good. For example, renewable energy. Okay, in the history, the cost of renewable energy creation was very huge, but now because of government subsidies, because of new technology coming, government opening up, okay, the cost has gone down, and now it is easy for you to generate that much amount of return. I'm taking a pause. Okay, Prachi, answering to your query, empirical analysis means comparing with historical data. However, alternative investment does not go with the past historical data. No, it is not like that. They are saying any investment strategy. Okay, one way you can do it is you can look at the past, and from that past you can make some analysis. So you can do some regression, you can do some level of forecasting. Okay, but the second part is the economic reasoning part is saying, okay, you can do that, but you have to check whether your understanding is correct or not. So it is not only specific to alternative investment. The same logic is applied to your equity also, your bond also, because you have data available. You can look at the past data and see how this company is performing, or how the market is performing, how the index is performing, right? Read till this point, everybody. The metrics which I was initially talking about, okay, so this is the metrics which is there, okay, and look at the 2x2 metrics that they have created. Okay, what is the primary objective? Okay, I'm just going to zoom in. What is the primary objective? Is it diversification? That means, is it risk reduction or is it return enhancement? Okay, and how I'm investing? Am I investing privately or publicly? Okay, privately means I'm one of the example of this. This could be I'm buying a stake of a private limited company. Okay, publicly means I'm buying a share of a public limited company listed on an exchange. Okay, so that is a broader bifurcation, and the main requirement is over here. What is the primary objective? So they've bifurcated it. Okay, so when you look at hedge funds, okay, hedge funds do invest into public limited companies. They buy stocks, bond and all. But when you look at private equity, they invest into private limited companies. Okay, so they will, suppose there is a startup which is a private limited company. That startup, okay, you're going to invest, okay, as a your private equity fund, you will buy some stakes of that company. It is not available to everybody. Okay, it's a private investment. So over here they are bifurcating public and private, and look at the returns. Both of them will give you very high extraordinary returns. So if suppose say venture investor, okay, like Ashneer Guru, he is buying a stock in say Ola. That's a private limited company. Okay, it is a risky investment and it's a private limited company. Okay, so private transaction. But if I'm going to buy say real assets, now real assets could be, some real assets could be publicly available, some real assets could be not publicly available. For example, I'm directly buying a property into a mall and the ticket entry size is very high, so it might not be available to everybody. But if that same mall is listed as a REITs, real estate investment trust, then it is publicly available. Okay, again over here we invest from the perspective of increasing your diversification aspect, which is reducing my risk. So I'm investing into this asset because I've already invested somewhere else and I want to make sure that the risk of the portfolio is managed. Okay, that is a 2x2 matrix, and the details are also here. You'll find a similar screenshot in your book also. Over here I've given an additional example. Okay, look at this. If you're investing into gold ETF, okay, these ETFs are nothing but, you, instead of buying a physical gold, okay, you're buying a gold ETF which is listed on the exchange. So first of all, it is publicly available. Okay, publicly traded, and this is low risk because it is backed by that asset price. So whenever the gold price will go up, it will be protected. Okay, look at the second category, infrastructural projects. Now this is a private transaction, it is not available to everybody, and in certain infrastructure projects, now this low risk that I mentioned, okay, is from the perspective that regulator is supportive. If there is a change in regulator, change in policy, then the risk is very high. But most of the infrastructure projects, you have a contract in such a way that you will end up making a stable revenue over a period of time. A toll road is a very good example. So you are building the road along with the government. Government is giving you the right that for next 20 years, you're going to be collecting toll from this road. So you know that this is a busy area. The toll will be used, the road will be used every time. So it will generate stable and long-term return. For next 20 years, you will be able to generate return. Okay, initial investment is definitely there. Look at the third section. Okay, an hedge fund is creating a portfolio of stocks, but he's not just taking long position, he's also taking short position. He's also taking leverage. So this is a public strategy because he's buying stocks, but it is a slightly higher risk. It is not similar to a mutual fund. It is slightly taking higher risk to generate return. And look at the fourth point, venture capitalist. I gave you the example also. You're buying stake in startups like Ola, Uber, and all of this, right? To generate very, very high returns. Okay, over here also the risk is going to be high. Okay, I'm going to take a pause. Any query, any confusion? I think so. We have reached to the end. Okay, this is nothing but a summary of whatever points we have discussed till now. Okay, and the matrix is what you have to remember. So you can mark this matrix as star. Okay, any query, any confusion till this point? All good. So with this, we have completed the chapter.